Washington Post, Forbes, Wall Street Journal slam for puff piece reports on FTX and Alameda execs following the highly criticized New York Times article that features commentary from the former CEO of FTX, Sam Bankman-Fried, SBF. The public continues to give the mainstream media flack for publishing. Critics say specific FTX-related articles published by Forbes, Washington Post, and the Wall Street Journal give praise to FTX and Alameda execs. On November 15, 2022. Bitcoin.com News published an article about the criticism a New York Times NYT article received after it published an article that said the former FTX executive Sam Bankman-Fried, SBF, was sleeping better and playing video games. People were not too pleased with the NYT article, and critics said at the time that the news publication went soft on SBF. For instance, critics slammed the Washington Post's Dan Diamond for his report called, "Before FTX Collapse, Founder Poured Millions into Pandemic Prevention." Diamond's report highlights SBF's significant donations toward initiatives that would prevent another pandemic like COVID-19. Public opinion has spoken. No one cares that Alameda's top exec was a Harry Potter fan, or so-called math wizard.
On November 6th, the token's value began to fall, losing more than 80% of its worth in the span of 72 hours. Once seen as a survivor in a struggling market, the fall of FTX has sent shockwaves through the cryptocurrency industry. So, what went wrong? FTX is the brainchild of Sam Bankman-Fried. He's commonly known as SBF on social media. He's been previously hailed as a savior of the crypto industry.
You were called the JP Morgan of crypto.
Yep.
Does that bother you or did not?
It doesn't bother me too much.
Bankman-Fried founded the quantitative trading firm Alameda Research in 2017. 2 years later, he started FTX, an exchange platform for buying or selling cryptocurrencies. Right now, he's the majority owner of both firms.
That kind of aroused some skepticism among industry players and traders, investors, stakeholders, that there could be some sort of conflict of interest in terms of whether Alameda Research was getting preferential treatment on FTX, vice versa. But the official narrative that SBF gave in the past is that the two companies are separate entities.
After its launch, FTX attracted major investments from Silicon Valley and Wall Street.
We've raised a few $1 billion over the course of the last couple of years, and we're a profitable business.
It grew into the fourth largest cryptocurrency exchange for derivatives trading. Celebrities promoted the platform in ads.
I'm getting into crypto. With FTX. You in?
It's FTX. It's a safe and easy way to get into crypto.
I don't think so.
FTX was gaining steam, and in the process often tussled with Binance, the world's largest crypto exchange by volume.
When FTX was getting started, Binance invested in FTX, and it was one of the crypto exchange's earliest investors. But FTX, as we know, grew really rapidly, a very substantial rival to Binance.
As FTX grew in the industry, Bankman-Fried furthered his reputation as a crypto savior when digital asset prices collapsed earlier this year.
It's not fair to customers.
He bailed out firms, spending about $1 billion.
It's okay to do a deal that is moderately bad in bailing out a place.
But that image didn't last. On November 2nd, CoinDesk published a report based on a leaked Alameda balance sheet. According to the leaked data, Alameda claimed it had over $14 billion in assets at the end of June. But most of that was FTX's tokens. Alameda CEO Caroline Ellison tweeted that the balance sheet wasn't complete.
Caroline also said its financial situation is under control, the company is doing well. However, it seems like the market just didn't really buy that, and then traders continue to withdraw from FTX.
FTX and Alameda did not respond to a request for comment. Things escalated on November 6th when Binance said it would offload hundreds of millions of dollars of FTT. Binance did not respond to a request for comment. The announcement sparked mass withdrawals. That day, FTX processed $4 billion of transactions, many times the normal amount for a day. Some got backlogged, which sparked demand for more. By November 7th, that number ballooned to $6 billion. On the 8th, a day later, FTX's finances were in crisis. Binance stepped in and said it would buy the company. It seemed like FTX might have solved its liquidity problem. But on the 9th, Binance backed out of the non-binding acquisition. The next day, the Journal reported that FTX used money from customers to fund risky bets made by Alameda.
It's a shocking revelation for a lot of people in the industry because even though there has been a lot of speculation about FTX and Alameda Research being joined at the hip, nobody could have foreseen that SBF was willing to transfer billions of customer funds at his crypto exchange to help his crypto trading firm.
The Securities and Exchange Commission and Justice Department are investigating FTX, according to a person familiar with the matter.
This is not like the New York Stock Exchange or NASDAQ. They take people's money, they borrow against it, it's not much disclosure, and then they trade against their customers.
A spokesperson for the Justice Department declined to comment. Bankman-Fried told investors that FTX couldn't cover withdrawals since its collateral was dropping in value and couldn't be liquidated, according to people familiar with the matter. On the 11th, Bankman-Fried resigned as CEO, and FTX and Alameda filed for bankruptcy. Afterwards, FTX said it was probing a potential hack. More than $370 million worth of crypto funds appeared to be missing, according to crypto analytics firm Elliptic. On the 12th, the Journal reported that Alameda and FTX executives knew that FTX had lent its customers money to Alameda.
So a lot of retail traders and investors I've talked to are feeling desperate or frustrated. The majority of the people in the industry could not have seen this coming because FTX is such a dominant player.
The fallout has led other companies to tout their reserves and call for more transparency in the industry. As of November 11th, according to the bankruptcy filing, FTX's estimation of their liabilities would make it the largest crypto-related bankruptcy ever filed.